Happy Saturday, everybody. Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's #2 economy. My name is Tony. Let's jump in. Now, we have a big video today, a lot of material to move through, and it's likely we will have another extra episode tomorrow on Sunday. Yesterday, Beijing published its official data for December, and by extension, all of 2024. Today, we will be unpacking these numbers and examining the devils in the details. Now, at this point, as we will see, there is little trust in the official numbers, and we will discuss how things are likely much worse than the headline growth figures would suggest. But first, it is important that we note the official numbers. China's economy officially grew 5% in 2024, fueled by a late-year policy blitz and an export boom. Gross domestic product surged, officially at least, 5.4% year-on-year in the fourth quarter, marking the fastest pace in 6 quarters and aligning with General Secretary Xi Jinping's New Year forecast. Now, even if these numbers were accurate, despite the strong finish, deeper economic concerns remain. Consumption growth lagged behind pre-pandemic levels, with retail sales growing at 3.5% last year. Property investment saw its steepest contraction on record, and deflation persisted for a second consecutive year. Adjusted for falling prices, nominal GDP grew only 4.2%, the slowest rate since the Mao era in the late 1970s, excluding the pandemic period. And this is assuming the numbers are accurate. Indeed, deflation is especially concerning. Producer prices have been in negative territory for more than 2 years, and consumer prices managed growth of just 0.1% in December. Many economists believe it is likely lower than this as well. Some of the biggest Wall Street banks, including JP Morgan Chase & Co. and Citigroup Inc., are predicting that deflation will linger through 2025, marking a stretch unseen since the end of Mao Zedong's Great Leap Forward campaign, which plunged China into recession and caused a famine that killed tens of millions of people. Bank loan growth slowed to an annual 7.6% in December from 11% a year earlier. Government tax revenue in the year through November was 3.8% lower than the same period in 2023. Export strength, which contributed significantly to 2024's growth, faces headwinds too. President-elect Donald Trump's threats of steep tariffs on Chinese goods, up to 60%, pose a serious risk to trade, one of the few bright spots in China's economic data. Analysts warn that global businesses' rush to front-load shipments last year could leave China vulnerable to a sharp export decline as tariffs and trade tensions rise. We will return to trade in tomorrow's video. Beijing plans to address these challenges with a mix of fiscal and consumption-focused strategies. Authorities aim to expand subsidies for equipment upgrades, consumer goods trade-ins, and medical insurance, potentially doubling funding to 600 billion yuan, $40.9 billion US. Local governments may also use special bonds to address housing supply issues by acquiring unsold properties and unused land. But as we have seen over the last few months, a lot of this is too little, too late. And progress in easing the real estate slump has been slow, with 2024 seeing a 10.6% plunge in property investment, the sector's worst performance on record. This slump has offset gains in manufacturing and investment spending, undermining broader economic recovery efforts. As deflation entrenches and export uncertainties loom, experts caution against policy complacency. Quote, "Now is not the time for Beijing to rest on its laurels," end quote, said Lu Ting, chief China economist at Nomura Holdings. With significant global and domestic challenges ahead, China's growth trajectory in 2025 remains uncertain. Now, these are the official numbers. And of course, economists, both foreign and domestic, have long raised concerns about the accuracy of China's GDP figures. Eswar Prasad, professor of trade policy and economics at Cornell University and former head of the International Monetary Fund's China division, expressed yesterday, quote, "These growth figures stretch the bounds of credibility and will do little to build confidence or alter the picture of an economy that is on the ropes," end quote. Adding, quote, "A better read for the economy is provided by flailing stock markets, continued turmoil in the property sector, a deepening currency, and capital outflows. These indicators are hardly consistent with an economy hitting the growth target on the nose," end quote. Indeed, some scholars believe that the data could be off by as much as 2 percentage points, a distortion that has only grown in recent years. According to these experts, China's weak consumer price inflation, which has remained under 1% for months, and prolonged negative producer price growth are clear indicators of weak demand. These economic signals suggest that the economy is stagnating despite the government's optimistic growth projections. The country's ongoing property sector crisis has further exacerbated these issues, sidelining local government investment and consumer spending, both critical drivers of growth. Analysts at Rhodium Group estimate that China's actual growth in 2024 could be closer to 2.4%, much lower, indeed half that of the official target. They have argued that China's economy is likely 20% smaller than it officially is. They also highlight distortions in key economic areas, including household consumption and gross capital formation, which have been negatively impacted by the downturn in real estate. And of course, as we have explored in previous videos, with surging debt, this is not healthy growth either. Even state-owned enterprises are not immune from economic downturns. Many companies are cutting salaries and postponing large investments. An employee at one state-owned firm in Fujian province, speaking to UK-based The Financial Times this week, reported a salary reduction of over 20% compared to 3 years ago, despite a promotion in 2024. As we covered earlier this week, financial regulators in Beijing have seen pay cuts as high as 60%. Now, we have a few more updates to cover, but just quickly, if you're getting some value from today's episode of China Update, I have a huge favor to ask. That is just to hit the like button. And if you have not done so already and you think you'd watch another one of these episodes, subscribing is also a tremendous help. Thank you so much, everybody, for the ongoing support. Let's continue. In another sign of the country's long-term structural problems too, China's population shrank by almost 1.4 million in 2024, the third consecutive year of decline, as a slight rise in births from the previous year to 9.54 million was outstripped by 10.93 million deaths. On this point, we will end part 1 with these observations by Peking University Professor of Finance Michael Pettis. Quote, "It seems to me that much of the discussion surrounding the population decline may be a little overdone. The real medium and long-term challenge for China lies in the way it rebalances the domestic distribution of income. If it can raise household income fast enough and in turn non-disruptive ways, a declining working population is still consistent with rising living standards, even if that means, as it most likely does, a slowdown in GDP growth rates. If it cannot, a declining working population will be the least of its problems. For me, the real demographic problem China faces is not the decline in its working population, but rather the unevenness of that decline. That's because the working population will continue to rise at a healthy pace in the faster growing, richer eastern parts of China. The rest of China, however, with its low income levels, weak growth, and unmanageable debt burdens, will absorb more than 100% of the decline in China's working population. What is worse, it will be their best educated and most entrepreneurial young people who will migrate, with this area already comprising a disproportionate share of non-productive investment in property and infrastructure. A declining working population means that the economic value of this investment will fall even faster, worsening the debt burden. If this forces the poorer parts to cut back on educational spending and social services, it can further entrench the disparities. The question is how Beijing will respond to these rising difficulties. It would have to choose between diverting resources to richer China, which would be better for the economy, or to poor China, which will be better for social and political stability. I'm not sure how Beijing will respond, but I tell my clients that we should increasingly consider not just how the Chinese economy will choose or be forced to adjust, but perhaps even more importantly, how unevenly this adjustment, including the demographic adjustment, will be distributed throughout the economy." End quote. Next up, in yesterday's video we asked whether TikTok might be saved at the last minute. Today is looking far less promising for the popular Chinese-owned social media giant. In a landmark decision on Friday, the Supreme Court upheld a federal law that effectively bans TikTok in the United States unless it undergoes a last-minute divestiture from Chinese ownership. The unanimous ruling has plunged the app, which boasts over 170 million US users, into deep uncertainty, with the deadline for compliance looming just 2 days away. The ban or sale law, passed in April of last year with bipartisan support and signed by President Biden, addresses national security concerns regarding TikTok's parent company ByteDance and its potential ties to the Chinese government. The court decision asserts that the law does not violate the free speech rights of TikTok users, citing the scale of sensitive data collected by the app as justification for targeted action. TikTok has announced plans to go dark on January the 19th unless the Biden administration intervenes. The Biden administration, in a curious move, has said it will not enforce the rule, even though Biden himself signed it into law. President-elect Donald Trump, who assumes office the following day, has vowed to save the platform, but his strategy remains unclear. Reports suggest he may issue an executive order to delay enforcement of the law temporarily. Legal experts, however, question whether such an order could override a congressional mandate, especially since now it has gone through the Supreme Court. The ruling has sparked mixed reactions. Free speech advocates, including the Knight First Amendment Institute, have criticized the decision, arguing it expands government power to restrict speech under the guise of national security. TikTok creators, who have used the app as a platform for creativity and discourse, have urged the government to find a resolution that preserves the app's accessibility. There are also those who have long warned about the Chinese control over the app, the connection to the Chinese government, and why it really is a deep national security concern for Americans. TikTok's future remains precarious as enforcement looms. The law, known as the Protecting Americans from Foreign Adversary-Controlled Applications Act, imposes steep fines on app stores and hosting services that continue to support TikTok after the deadline. ByteDance has refused to sell the app, with the Chinese government opposing divestiture, further complicating negotiations. With no sale imminent, TikTok employees in the US are preparing for various scenarios, including a potential shutdown. Many users have already begun migrating to alternative platforms, while some speculate on high-profile buyers who might step in. Earlier this week, we discussed reports that Elon Musk might be under consideration, but nothing more has really come from the story. And indeed, even if a buyer is found, even a temporary ban could lead to irreparable damage to TikTok's user base and reputation. The coming days will be pivotal for TikTok, as the app's fate hangs in the balance amidst legal, political, and international negotiations. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. Have a good Saturday, have a restful weekend, and I will see you all tomorrow.